Scott, welcome to the show.
Thanks for having me.
There are a few people on this planet that really motivate me, and Scott, you're one of them.
Well, thank you.
Scott is a beast, which we'll get into right now. We've known each other for quite a while and work with a lot of the same folks, but what you've done is like nothing short of amazing, and we're going to talk about it today.
Thank you. Well, I'm glad I paid you to say that.
Yeah. 38,000 units by 32 years old. So that's more than 1,000 units a year for every year of your life. And you've made it look, I wouldn't say easy, but it seems like it's just been like supernatural for you to just continue growing.
You know, it's weird. It's so hard until it's not. And then it just seems so easy.
Yep.
Obviously, rising tide lifts all ships, but the first, 5 years of doing it, it seemed like every pain point was just an ultra challenge. And then all of a sudden you look up and you can just take down 10,000 units and your team just executes, seamlessly. So, it's been a wonderful ride.
Well, we're going to end. One of the last questions is, how would you describe kind of your superpowers? Because it takes somebody to push it that far, and we'll get there. But start with the story of you were getting into development, you thought that was the path, and then you got kicked in the teeth, and you're like, okay, maybe I'll pivot and do something different, which was value-add multifamily.
Yeah. Value-add multifamily has such a big sticking point these days in the news and with investment thesis. But when we started in 2012, it was lipstick on a pig, and that was the term I heard 100 times over and over and over. And so, backing up to 08, 07, I actually got into real estate right out of high school to flip houses. Obviously, that was our pending doom. But I did set up a small fund with a 60-year-old man who wanted to kind of bring me under his wing, and I was going to work for free and just help him with, chasing deals. And, he had to go get a job. I think everything fell apart for him in his own life. And that led me down the path of chasing single family. Once that imploded, I just tell people I read too much Art of the Deal from Trump, and I found myself on LoopNet looking at distressed office towers in of all places, Sundance Square. And I'm touring a deal, and the guy says, I think office towers are dead for the next 2-3 years. You should look at our apartments. And I wrote that down. And, kind of went over there and fell in love with the business plan. And development was obviously the sexy, cool thing to do at the time. And I ran around town putting land deals together. I had a development JV set up with a couple different groups, and just quickly figured out development is a rich man's game. Yep. And it is slow burning and takes a lot of capital and it's very intensive. And so 4 years of beating my head against the wall, I said, it's time to figure out something else to do. So lipstick on a pig it is. Didn't
you put together a lot of land like in maybe Design District or Deep Ellum for like $12 a foot or something? Yeah. So funny story. We own it now. That exact land, for 2 years I worked on it. It was a development deal of 30 acres, Lemon in the Tollway, Oak Lawn, heart of Dallas today. $22 a foot to the dirt. And I couldn't get an equity partner in the world to even pay attention to us. Yeah. And I had Pogue, who's, Lincoln property, behind us as the developer, and everyone said $1.20 rents north of Tollway, you'll never get it. Mind you, this is 2010, so yeah. I get it then. But so, it was just like, man, I got to make a paycheck. So I switched out and we moved on. 8 years later, we get a call. Hey, it's available. And we bought it. And now it's value-add apartments. You don't have to tell me what you bought it for, but I'm guessing it's more than $22.
It's a hell of a lot more. And it's worth even, gosh, I don't know. It's been crazy, but yeah, worth a lot more today.
All right. So you kind of get some wisdom that, hey, maybe you should start putting lipstick on a pig. It's an easier. What was like the first deal, or when did you say, okay, I'm going to start focusing on apartments?
Yeah, I'd say it's a mutual friend of ours, Adam Blake.
Yep.
I was getting tired of reading about how cool he was in the Star Telegram, and he'd bought the historic electric building, value add deal in downtown Sundance Square. And I just called him and said, hey, can I take you to lunch? And that was the first time we'd ever met. And he was a young entrepreneur,
came out of TCU here locally, and that was really when I kind of started thinking there's something here, and I should really figure out how to do this type of structure and deal. And so I spent probably another year or two really bouncing around between development and trying to find a value add deal.
Yeah.
You know, I had a deal in South Dallas, $6,000 a door. Still couldn't get anybody to do it, and so you know, deals just kept dying on me. And finally was able to in 2012 get our very first value add deal done in Denton, Texas, where no one else at the time would go, and we finally were able to get a good enough deal to get it under contract and attract capital.
We both have Adam Blake in common.
I know. I think that's how we all got connected. And funny stories, just he connected me to my very first investor.
Which we're going to talk about.
You know,
he called me, I will never forget, like this was 10 years ago, and I wasn't doing, you know, shit. I had a few houses, thought I was great. And he's like, I met this young guy, and I think he's going to be huge. And you kind of hear that story all the time. Oh, this, and it's like, yeah. And I remember like 3 or 4 years later, he's like, he just did his, you know, 10,000th unit or whatever. But he really early on, I will never forget him talking. And maybe you were in North Richland Hills or Denton, and he was like, he's tying up these shitty apartments, he's putting some lipstick on them, and blah blah blah. Yeah,
well, he was envious because at the time he'd sold his apartments and moved into solar energy.
Yep.
And you know, I mean, I gotta love him for it, but yeah, he had made a lot more money in apartments, and you know, we kept in great touch, and I just always felt like he's just a phenomenal entrepreneur, and he went on to do a lot of other great things.
Yep.
But he was really kind of my launching pad for really focusing on value add, and then connecting me with my first investor.
Yeah.
So it was great.
We share that in common. I tell everybody, if it wasn't for Adam, I don't know how things would have shaken out.
Well, yeah, now he's just hanging out on the beach in San Diego, living the life.
Was there something early in your life? You have to have confidence to be as young as you are. And it's maybe something we share also, is just thinking at an early age, like, I can do it. Did you grow up that way? Is it something like you remember? It's like, yeah, it's made me confident.
I think, you know, I'm the oldest of 4 boys.
Okay.
So there is a little bit to birth order, I think. You know, I always a little bit, I wouldn't never say cocky. It's definitely just a confidence. And I was a terrible student. So, you know, I was literally bottom 10% of high school class. I was in detention all the time. I had to do summer school every year of high school. So for all intents and purposes, I was nothing remarkable at all in sort of education. But I always felt like I love to learn. I'm extremely curious. I'm extremely competitive. And I pretty much understand that if someone out there can do something, why can't I do it?
Yeah.
And it's a simple concept, but I feel like people have fear paralyze them. And what we do, either as entrepreneurs, finance, real estate, whatever it may be, tech, we're not splitting atoms here. It's just the confidence in yourself to go do it and take the risk. And I tell people, you know, my biggest advantage was starting so early, because the things I did, the risks I took, I probably didn't even understand how much I could have screwed up my life if they went the other way.
Yep.
You know, I was borrowing from JP Morgan Chase. I was borrowing my student loans to use them as pursuit costs for real estate deals. And then I would pay the school with my credit card to get in proof of enrollment, and then I'd send the proof of enrollment to JP Morgan so they wouldn't call my loans due. And then I would cancel and get my money back on my credit card. And I did that for 4 years. I got $100,000 in student debt at 20% interest rate. That's not forgivable in Chapter 11 personal bankruptcy. And you know, it just kept disappearing on me chasing deals. And finally it worked out. But my gosh, you know, if I'd have told someone at 20 to do that, it would never happened.
Yeah, it's not the recipe for everybody.
Yeah,
don't do that. Don't ever do that. All right, so Denton comes along. What did you see in that deal that was like, all right, this is the first one, and how'd you get it done?
Yeah, so first deal, 184 units. You know, I had an older partner at the time, and you know, we, after looking at a lot of deals, you know, you started to kind of figure out what could kill you and what was, you know, what to look for. And so we found a really underoccupied deal that needed to be transitioned from like student housing, so it had a ton of vacancy. And we were able to time it right with an investment group who the investor had sold his company, or a big piece of it, a majority piece. So he was liquid and was looking to also bring and raise some capital for, you know, what they call private equity real estate. And the deal needed about, $7 a door was our budget. We totally missed on all of our assumptions. We were buying a 60s flat roof chiller deal, and we forgot to budget to possibly replace roofs, possibly replace the chiller, and we most importantly forgot to budget for interest carry on a construction loan for transitioning from student to traditional. So we screwed up everything we possibly could. But what I did every day was I drove from Dallas to Denton, 5 a.m. I'd get up, I'd go up there, and I lived that site every single day of my life. I remember I was buying baby powder, because June, that was when all the students were moving out. And, I'm up there every single day punching out units, getting them turned as quickly as we could in the dead of the heat. But it was the best thing for me and the best education, because I learned how everything plays out on site. I figured out how all the tenants work. I figured out what you get paid for on the value add improvements. I figured out where you can cut corners for cost purposes and truly the kind of value add. And I figured out how to manage an asset on site from the ground up. And that's where we started our general contractor. After 3 GCs that kept lying and not doing what they say they're going to do, I said, screw it. We're going to drown. We're literally going to lose this deal to the lender. We were 60% occupied and no end in sight to our bleeding. And so I said, I'm going to hire some painters and I'm going to make it happen. And, I did everything from lease apartments to move people in, to punch out the units, to manage the rent roll, and just figured it out. And, rising tide lifts all ships. Like I said, rents started climbing a little bit, occupancy started climbing. We were able to stabilize, got out at a good cap rate, and put a win on the board as quickly as we could. And that's what kind of launched into the next deal.
Was there like something in that deal where eventually it kind of clicked and you're like, all right, I think I kind of figure out like how this business is going to work?
I'd say that it took until about the third deal to really feel like I was starting to understand just the small pain points that make a deal work or don't work. And today, the physical nature of an asset doesn't scare me at all. I pretty much can be on site in 30 minutes and know if we're going to have some challenges or not. There's a lot more things today that worry me from a more macroeconomic perspective than being very comfortable on site with a physical deal. But I think that's where a lot of people can get really penny wise, pound foolish, and in the micro weeds and just not paying attention to what's really important. And all that matters is leasing and rents, and being in the right markets. And, I always say just good leasing and high rent solves a lot of our issues. And so the one thing that we start with on every underwriting is just where are the rents today and where can we take them?
Yep.
Don't worry about anything else until we figure that out and we feel 110% confident that we have it down. So
how often are you creating the new comp though? Like when you think about where we can take them? See,
yeah.
It's always, there's already rents out there that we know we can get to.
My investment team knows, don't bring me a deal if you're going to try to be the market rent leader.
Yep.
If you want to try to tell me that our 1991 deal is going to compete with new builds, just go ahead and throw your memo in the trash. It's bad business plan. Our whole investment philosophy is target off-market, target the deals that are underperforming everyone else, figure out why they're underperforming, and make sure it's not for a reason that's legit. And if not, start getting aggressive. And I buy something that all you got to do is take it to market to make good money.
Right. Okay. What are illegitimate reasons why properties are not performing? So you said like there's legit reasons why they could not be performing, like the chiller's gone and nobody has hot or cold air or hot or cold water. But in your case, like what are illegitimate reasons why most people overlook and you're like, no, this could be turned around really quickly?
Yeah, I think I think people don't fully understand that, unlike an office tower or an industrial building, I mean, a multifamily deal, 350, 400 units, it's like a living, breathing human almost. I mean, It has so many things that are required to kind of all work together, from the electrical MEP to leasing, office. It's tenant service for 500 residents. I mean, any one of those things starts to kind of fade, and you get into this kind of cascading effect of, now cash flows aren't great, and the partnership already was over leveraged. So now the general partners start kind of bickering and fighting. Then the manager quits because their budgets aren't getting approved. Now they have a big AR balance, so they're getting blown up by the vendors. I mean, there's all these nightmarish scenarios that play out. And so like one thing we look at is just landscaping. It's a very simple, easy tell of if a deal is performing or not.
Yeah.
The first thing that people start cutting is those nice new pretty flowers every quarter. And so you can start kind of seeing signs of not distress, but people who are not wanting to redeploy capital in the asset. And so, it's you kind of just know, but also with the rent movements we've seen today, it's reset the floor for what we consider, the stabilized market. And so you have a lot of REITs out there, you have a lot of 1031 owners, you have a lot of family office owners, all focused on cash flow, and we're total return value add people. So, what's been interesting is like in 2020, 2021, and 2022, the rents have moved so fast that if you're not on the ball month to month, quarter to quarter, and sometimes week to week, you've missed 15, 20% of in-place rents, and that alone could be a value add for us. So it may be working well. It's just you've got an owner that's, messing around in Cabo, not paying attention. You could easily pick up 10, 20% value just by being in the right place, right time.
Well, you're in the right place at the right time. I think you've bought, I had my notes, but like 105 deals, and you're not participating in all these auctions to win these deals. You're getting them. So to the extent you'll share, like, how do you think about creating an opportunity and buying a deal? Like, how are you, is it literally being able to show up at a property and go, there's depth, like the owner is obviously thinking about the property this way, it might be a time to buy. Like, how are you sniffing these out?
So everyone, a lot of people think that buying off market means I'm just calling every owner in town direct, right? And I can tell you 100% wholeheartedly that it is an absolute disastrous waste of your time.
Yep.
And I think people take that the wrong way. We hire people who we tell off market. All I see is they start blasting LOIs to all the different owners. I get probably 20 calls and offers a week, and I don't think I open one email. Yeah. I just delete. The only emails I'll open from anybody is through a broker relationship that I know and I trust, who's going to say, I vouch for this group. They're good buyers. This is a great offer based on what we're doing in the market.
Yep.
And even then, sometimes I'll most of the time just ignore it, but I at least pay attention. So, what we focus on is building out those relationships. We want a couple in each market, and we want to identify the assets we have kind of circled as targets. Yep. But I always offer through our broker relationships, and I respect the crap out of the brokers.
Yep.
A lot of people don't treat brokers very well, and it blows my mind. They control the keys to the kingdom.
Yep.
And, some of my best friends are brokers. They make a lot of money. They're very smart. And if you do what you say you're going to do and you make their life easy, you will get a lot of deal flow. There's a lot of people in real estate. I know it's shocking to everyone, but there's a lot of ego in this business. And, it's mind-blowing when I'm on the sell side or the buy side, just seeing how the other group treats the brokerage community or, their, investment team or lawyers or whoever. And we take a very different approach. We respect all those relationships. They're the lifeline of our company and our deal flow. So we want to respect it and make everyone's life as easy as possible. So we're your next call.
Do you find that you're buying from the same seller quite often now once you've executed enough?
Yeah. My whole thing is if we've got one deal going with a group, I want to know everything they own across the country.
Yep.
And let's start pinging.
Yep.
And I'd tell you 9 times out of 10, something else miraculously shows up, and it might be more than one. It might be even a portfolio, a subset portfolio, all types of stuff. So
you were in the lipstick in a pig era where value add multifamily in 2022, everybody can talk about it. It's easy. The new incumbents, they make it seem easier than it is, but you've seen it from when it wasn't sexy to where it is. I know you were at a different stage in your career early on, but like, how much has the landscape changed over the last 10 years?
It's it has become so institutionalized, and the metrics. I mean, CoStar wasn't really even CoStar 10 years ago, and the data available back then, you had to basically wait until an NPF report came out at the end of the quarter to know where rents were sitting. And like LRO and Rainmaker and all the day-to-day kind of rent technology we have, prop tech wasn't a word, that's for sure. And so what's crazy is just, we track so much data now. We've built out an entire software for our company, that when we're going to close a deal, I mean, everyone always says like, you're the crazy money, you're the crazy aggressive buyer, and that's why everyone wants to sell to you. But I mean, we have a very high conviction in what we're doing is it's not guesswork. It's all extremely proven and process oriented. And I think that's why if you look over 10 years, we have a very, very consistent track record of putting in dollars, getting 30% revenue bump and about a 50% NOI bump. And that is the math. That's the clockwork. And it doesn't matter if, we used to pay maybe 6 caps, 7 caps, but we were pushing spread. And so, we'd buy at a 5 cap, take it to a 7 cap. Today we're buying at a 3 and we're taking it to a 5 and selling at a 4. It's just the spread game. And so that part has not changed at all. What has changed is just the institutional liquidity in the marketplace, and the competitive set. You used to go to market and hope that you might get 2 or 3 real buyers, and now if you're not getting 20 LOIs at best and final, you feel like you failed. So, it's a good thing on the sell side, but it's extremely competitive on the buy side. And then operationally, I just feel like people have become extremely intelligent about how to extract value, and so you got to be careful on thinking you can do things better than the previous owner. You got to really understand why they're selling and where their failures were, and making sure you can do better.
One of the most impressive things, and honestly was a huge inspiration for us to get laser locked in on just doing industrial, was your focus. And it says on your website, it's like, this is all we do.
Yep.
Was that by design from the beginning? Did you just kind of look back over 5 years and go, oh shit, this is all we've done, maybe we should just do more of it?
I think we had that conversation. I think we were sitting at the golf club 5 years ago, and you guys did a bunch of really cool stuff.
Yeah.
And it was office towers and some master plan communities and some development of this. And I was kind of jealous, but at the same time, you were kind of looking at me like, man, that's such a pain in the ass trying to be an expert at everything. And it's just kind of grown over the years of people like the sector specific investment, kind of focus.
Yep.
And as we raise money, we hear it all the time of people who are frustrated because they put money with an operating partner or a general partner to do multifamily, and they're out trying to also source South Beach, Miami hotels.
Yep.
And, they're putting in a development deal down in Austin for, industrial, whatever, right? So we just kind of kept hearing that recurring theme from investors and decided, let's just be expert at one thing and one thing only, and make sure that we also, not only from an expertise on the execution side, but I want every broker in town, when they think, oh gosh, I have a live deal that needs a response in 24 hours and it needs a ton of capital and it needs hard money, and all these things that are usually challenging and problematic for a big investment allocator, who do I call? And I want to be that call every time. And that's where we've built our reputation is, I'm okay having my balls in a vice with earnest money because I know we'll close and we'll vet it very, very quickly. But, we get deals that I think, we had a deal in Phoenix. Guy owned it 40 years. Phoenix, the hottest market in the country.
Yeah.
And he was given a price that to him was crazy. Well, he's owned it 40 years. To us, it was like, you're selling this thing 100 doors short. But he wanted $5 million of earnest money released day one to be confident in his 1031 up leg. And because he couldn't afford to have all that stuff go south on him for tax purposes. Not a lot of people do that, but hey, we know we're going to close. We know we got the relationships and the capital and the know-how, and sure thing.
So you have institutional scale and size, but you don't have institutional red tape.
Right. You don't have an investment committee of 6. You don't have to go to the fund LPs for approval to put out, earnest money going firm. There's so much red tape around these mass allocators of capital. Where they win is they go buy, resource REIT, and can put, $100 billion of equity out at a time. But in the institutional world of buying a $100 million deal, you kind of fall into this too big for the private allocators, but too small for the big boys. And so we've kind of just sat right there in the middle market, and that's kind of where we plan to stay.
So like if we were just taking that Phoenix deal where he wants $5 million day one, to close the loop on just like the focus part, if you and I were both given that opportunity, I know what you know, I know what I know, you know what you know, I'm going to have to spend 30, 60 days calling everybody. Is this even real? Fact checking it. Whereas you might spend 60 minutes and be like, okay, we're good. Like in that, what does your mind go through in those 60 minutes? It's like, and it's probably more than that, but what level of due diligence have you done besides 10 years of working on this where you're like, I'm good, let's go?
Yeah. As I stated, it literally starts with rents. So I start there. If the rents in the pocket are not what I want, just to back in, because we're all pro forma stabilized buyers. I don't really care what my entry cap is.
Right.
So I start there. If that checks the box after kind of digging in, then we move into supply.
And that means that they're low enough.
Yeah, the spread is there to kind of get us excited to at least go through the modeling.
Right.
If that's there, we move forward. Then I check supply, because supply is the killer of all deals for us. We play in all growth markets, Arizona, Texas, Florida, Carolinas, Georgia. They're all markets that over a 50, 100-year period, we build ourselves into a recession. Right. Obviously, demand has been off the chart this last decade, but it happens. Houston, we learned our lesson. We tried to get smart and cute with it, and supply is just, it's too easy to build down there, and it's tough. And so that's kind of the second thing we look for. Then obviously we start trying to figure out just sales comps to back into what we think it's worth. And from there, then we start requesting financials, and we don't even, I'd say 9 times out of 10, I don't really need your financials to kind of know where I'm pegging it. I might move the meter 2, 3, 4%, but I can get you an offer kind of before I've even looked at anything. And then after that, I get my team on site, make sure I'm not missing anything physical or locationally. But it is literally a 24-hour process. If you bring us a deal, doesn't matter if it's, we put a 8-pack portfolio together, and $850 million took us all of 4 or 5 days. And it's just market expertise, the right relationships, and having a vertically integrated company that has its own GC. We have our GC license in all the states we operate in. So we'll deploy all of our subs on site, tighten up our budget, get our asset managers on site who all they do is value add multifamily, so they know exactly what to look for, sign off on operational budget, make sure the capital stack's good to go, and rock and roll.
All right. We're going to spend like the next segment on, let's just pretend we're all chasing a deal.
Yeah.
We got the $5 million. The guy said, I'm in, take my $5 million. You take the $5 million. What does S2 do, especially in another market? What happens from then to closing?
Yeah. So we usually have 45 to 60 days.
Okay.
That's the off-market world. They want hard earnest money, and they want you to waive all contingencies as fast as possible and close and rah-rah. So usually within a week, we turn PSA, but during PSA negotiations, we're getting updated title survey phase 1. We're going through all of their diligence on the Dropbox. We're checking the box on our full checklist. And before we even have PSAs, I usually want to feel comfortable I've already got the capital put together.
Yeah.
So we've already had calls, out of 75 deals, I've used 2 equity groups, Pennybacker and Trinity. And so, having those relationships, I'm always kind of like a little bit leery of people who've done like 50 deals and they have 40 equity groups.
Yeah.
Why does anybody want to keep investing with you? That's the first question.
Yeah.
So our thing is, rinse and repeat. And I know exactly, if it's this type of deal, this group wants it. And if it's this type, this group wants it. And sometimes there's some overlap, like the fund might be out of money, or they're raising, or, this group already committed too much. So then we might sprinkle in a few of our other groups. But so after we've kind of knocked out the diligence, it's all cap stack related, making sure our assumptions are vetted. I start calling directly my lenders. I don't circumvent the debt process. I like to use debt brokers.
Yep.
I like them to run the process, but I'll call my close relationships first, make sure, hey, this is what I'm thinking. What do you see in the markets? Good to go. Yay. Okay.
Bridge debt or long-term debt when you buy?
All short-term floating.
Okay.
You know, one of the managing directors at Starwood told me one time that fixing is for suckers. And I totally agree. I mean, we tried to get cute and fixed rate debt in 2017 and 18, and, you know, it was the worst decision ever, even though we thought we were locking in the lowest terms ever at 3.9. You know, the stuff we floated at a 180 spread heading into COVID turned into a 1.8% floating rate loan. And what you notice and I won't divert too much on this, but what you notice is just as rates rise, spreads tend to compress. And especially in this environment, there's just so much money chasing mortgage-backed securities and CLOs and such that I think it's probably what's going to happen in this next run. So, but, you know, so after that, you know, we pretty much believe by PSA signing in 5 to 7 days, equity's done, debt's done, physical diligence is done. Then it just becomes walking the units and fine-tuning budget. You know, we want to make sure, obviously, we don't miss anything like a flood insurance or whatever, but usually that's all vetted before PSA.
And physical DD on site is when you're buying 400 units, you walk in all 400 and you just walk.
We are. It's more of a check the box. Like I can just tell you that at least today, right? Like maybe in 2012, 2013, it meant a lot more to be on site. You might find all the copper was stripped, all the electrical panels were gone. You know, we bought some really hairy kind of foreclosure stuff where just anything and everything was at play. So those were a little different. Today, there's been so much money put in the space that in 4 years probably now, I don't think we've ever walked an apartment project and said, ooh, didn't expect that. It's kind of, you know, it's a box. It's got walls and a fridge. And from our perspective, we're going to replace all of it. So what do I care if I walk in and the flooring is a little rough?
Yep.
It doesn't matter. That probably just means the rents can go higher. So,
well, you said when you walk on site in 30 minutes, you can kind of tell if you're dealing with like a lemon or not.
Yeah, you can. You'll start seeing facade cracks, and you'll start seeing how the windows are separating, and you'll start seeing how the drainage kind of goes. And those are things you just learn. Yeah, those are expensive. They don't generate a lot of rent, you know, premium by fixing them. So that's where you got to be careful. You know how to cover your ass a little better.
You've done a masterful job of repositioning this stuff. So you always have your new sign. I could probably say a couple of them. You've got the bright colors. You've got the clubhouse looks good. Does that part start before you close, or is that kind of the first night? Because we're moving quick. 45 days goes by quick.
Yeah. I mean, as soon as we know a deal's being made, we engaged our design team, branding, signage, construction. And so that by the time we close, I want all paint schemes. I want all the design, branding, logos. I want it all done on site. We're throwing up new paint. I mean, IRR is strictly time, right? So, you know, everyone says, you know, oh, your track record's so great. I mean, it's not because we're so smart. We're just really fast, and we get stuff done cheap. You know, we have a lot of scale. We don't really tinker. You know, I laugh when I meet syndicators or something who have 5 different interior finish plans. I'm like, what the hell does that get you other than a headache?
Yep.
We have, you know, you'll see it over like the 10 years. You'll see like what deals were done from S2 from like 2012 to 2016. Then you'll see the 16 to kind of 19 stuff. And then now you'll see kind of like the latest refresh. But when we refresh our interior branding or exterior, it's like rolls out across all assets.
Yeah.
And we've just decided like this for right now is what works. We buy a ton of it. We price it in really cheaply. And then our subs all get paid basically per unit per floor plan. You make a little on one floor plan because it was easy. You make a little less on the other. Maybe this project, sorry, we're a little over budget. You're not going to make much money.
Yep.
But I promise you, you're going to go over to Florida and do 1,000 units and you're going to make a killing. And that's just kind of the give and go there. And it works.
Well, okay. So the value, it's like, you know, new appliances, laminate, hardwood flooring. It's the typical thing.
Yep.
But you just said you've redone it every, you know, few years. Is that because y'all get an insight that's like, hey, we can do this better? Or is it just the market saying what was cool in 2016 is not cool in 2019?
Yeah, I mean, it's a combination of what's available for kind of return on cost. You know, you know, if it's super new and super expensive, we might not get the rent push. But generally, you know, we try not to let our ego get in the way because we tend to want to make things as nice as what we live in. And you got to remember you're providing a workforce housing kind of need. And so you want to do as good of a job as you need to do to get the return. But all we do is track development, and we'll go walk new development stuff and see what's kind of in style, what's cool, what do we like. Maybe, take a piece of it and put it here and say, okay, how they're doing these backs. I mean, the guy, whoever owned that white sparkly granite, just killed it. That is everywhere. And so we decided, basically early last year, like it's time to move on from that. It's too cookie cutter, and so we've got some new stuff, but it's really just following the development trends.
Yeah. All right. Back to you. You've closed. Now we've closed on this gentleman that we gave $5 million day one.
Yep.
We close. What is the first? We can go through 90 or first 180 days look like from the day we close?
From day we close, you want to.
Do you notice all the tenants day one? Hey, I'm Scott, and here I am.
Yeah, I mean, it's more like I'm Michelle, and our management company is kind of showing up, taking over. But the one thing we really want to do is get rehab moving as fast as possible, so that when they get their renewal notice and it's an increase on their price,
right,
they feel the value of it.
Yep.
You'll lose so much occupancy if you just start giving out huge notices with the same old stuff. So it's an art. It's really not a science to rehab. We've got to do two things. We've got to renovate 100% of the units in 2 years, which is our kind of math and goal on the pro forma, and we got to do all the exterior and amenities in 9 months.
Okay.
So if we're behind schedule on anything, that's a problem. And so goal is always refinance end of year 2, heading into year 3. And our track record is basically refinance out about 75% of the equity. And so that 2 year is a huge hit the ground running. We need all those units turned, and in the first year, we're going to need to kind of achieve about 40% of that growth through unrenovated rents.
Okay.
So we don't always just turn all the units because they take too long and you'll drive your vacancy down. So you've got to kind of do this delicate tightrope walk of getting renewals up. Renewals have a cap on them. People just aren't going to pay you 30% more. But you can move people out and do quick, easy turns and get 25% pop on that unrenovated unit. And so we basically go through the rent roll and figure out who's been kind of skirting the system, paying $400 or $500 below.
Yeah.
Those are the first ones that are probably going to go, and then usually have the roughest units, and they need to be upgraded. So those will be completely renovated and turned. Then we'll find the person that just moved out because they're moving jobs and they're moving cities. They might just need a quick paint, so we don't turn those units. And then you kind of just balance of trying to push rents about 15% kind of in-place rent roll the first year, while all the amenities and exterior and leasing office and pool, all that gets done. And then when you really start to see the push is kind of that year 2, post-refi year 3.
Okay.
And so that's the general.
All right, I'm not letting you off the hook. This is fascinating. So you got 400 units. It's like a little city.
Mm-hmm.
So let's just say you buy it and there's, 30 vacant units the day you close.
Yep.
Do those get hit first?
Probably about half get hit.
Why
for
would
a full rehab?
Okay.
Well, because what's going to end up happening is I'm already looking at the kind of lease expiration for the next 90 days, and I'm saying, hey, I'm pushing rents on these units probably $300 after I renovate them, let's say.
Okay.
I know that I'm going to have some market issues because we're not fully renovated on the exterior, amenities, office, all that stuff. So I'm going to lease slower at the beginning.
Got it.
So I need to get some ready product that I can just fill up cheaper,
Yep.
And keep my occupancy up, because I'm probably going to lose 8 to 10% here over the next 90 days because people aren't going to renew at my rates.
Got it.
So, it's kind of like what I said. You got to fill them up to bring them down. And by doing that, you push the rents on the front end up, and then you can kind of get access to the real low payers. And then the people that are closer to market, you just kind of let them hang out there.
Got it.
And then what we try to offer up is more of like a hotel option of move out for a little bit, move into this unit, and we're going to renovate and move back at your new rate. And a lot of times, $200 or $300 for what we do, people take it. And especially in today's environment, everyone reads the headlines. Everyone's terrified to go find a new apartment. They don't know where they're going to go, if it's going to change, how much, and they're still going to pay a ton of rent. So,
yeah. How long does a turn take? Like a full turn?
6 to 8 weeks.
6 to 8 weeks if you're doing the full deal.
Yeah.
And that includes?
Yeah, everything. It's cabinets, appliances, backsplash. We're doing a lot of tub surrounds. Sometimes we're doing walk-in stand-up showers, closet improvements, all lighting packages, baseboards, everything. So we want to kind of look at it like, you know, obviously you might be in a 1990s project, but once you feel like you're in your unit, your box feels like any other box would if you were in a new development deal. And hopefully we want to try to keep that spread $300 or $400 below.
On those like 400 units, are you like, okay, you're closing, and I know that you're not the person anymore going, hey, it's Scott, I'm here. But the team has let the residents know we're here. We're about to improve your property, improve your life. Do you give people, it's like, I know your lease isn't up for 9 months, but would you like to start talking now? Or are you typically just talking to people once you're getting close to renewal?
We usually, it starts kind of 120 days out.
Okay.
You know, and we track rents in by unit and floor plan week by week. We have a long call where asset managers, I mean, we're going through every single unit.
Yep.
And what we think last week we got, what we can get this week, where those rents are going to move to. You know, if we're anticipating maybe a summer bump, do we start incorporating that? Are we seeing kind of maybe an eviction trend that we need to be wary of? And so let's start lowering those rents. I mean, it's a constant, fluid, day by day, week by week discussion with these tenants. You know, and it's hard. You know, asset managers and analysts and all these, they're all finance majors, so they're all just cranking through a million different data points on these things. But then you got to communicate this to a manager, who's then got to communicate to a leasing agent, who's then got to go explain, you know, how to kind of maximize the value and get these tenants, you know, signed up at different varying rates. And that's the challenge, and that's where having one strategy within the multi-sector has really proven to be strong for us, because a lot of these people have been with us a long time. They move sites and they start to get a feel for why and how we do things.
Yep.
Versus, you know, and it's why we don't third party manage. You know, I don't want another owner telling our team how they want to do things.
Right.
You know, I don't want you kind of having to guess if, was I supposed to do it this way? Or, you know, this guy wanted cash flow, so we're not really supposed to be pushing renewals, and it just throws the whole system into a loop. We have a kind of a set way to do things.
And do you actually want to get through all in 2 years, get every unit updated? Or if somebody was like, hey, I'm paying $1,000, I'll just pay $1,100, but don't do anything.
Yeah.
Do you treat that as an equal to the person that goes, I'll pay you $1,300, but redo it all?
Well, we all live in this world of, you know, compressed cap rates basically pay you for the future value. So, right. You know, if market's 3 cap and you've done nothing to the property, you probably are going to 2.5. So
yeah,
we take all that into account. You know, if the goal is to turn the asset quickly, we might do 30%, 40% of the units, and then start, you know, over the next 12 months after it's kind of done, start really pushing those unrenovated, and letting that saturate, because, like I said, it's hard to capture occupancy and maximizing rents on these rehabs while things are still constantly in flux, where you're moving people out, but you're renovating. And so if you kind of let it sit for a minute, let it play out, you tend to get more value. But then, you know, you've got this embedded upside because you're only 40% renovated or whatever. And so then you get a better cap rate. So that's something we just have to look at kind of week by week, month by month.
And, you know, everybody's kind of dealing with this, but even for projects maybe you bought right before COVID or during COVID, you're like, hey, we're going to do our best to raise rents, you know, 20, 30%. And then they just raise themselves without you doing anything.
Yeah.
As an owner, do you still think, hey, let's keep with plan? Or it's like, we got our 30 and we hardly even did anything?
No, I mean, we look at it like, we got 30 without doing anything. Should we be getting 50 if we do something? And, you know, I'd say that is really the case. I mean, I think we were one of the first to get buying again in COVID. We closed on a 3-pack in June of 2020. And, you know, basically we looked in March, April, May and said, you know, everyone kept reading this headline, and it was driving me insane, like 90% of rent collection, 92% rent collection. I got news for you. We never collect 100% of rent. That is just what it is. It's always 90, 92, 1% bad debt or so, 0.5% moves out and just evicted, but the rest rolls to the next month, and then you got to grind it out to collect it, and then they catch up because of whatever. And so we were like, you know, hey, cash flows are good, rents are good, government's basically backstopping us on all this. And, oh, by the way, I can buy stuff at a 5.5 or a 6 cap, and I can borrow, you know, floating from Freddie at 1.8. I'm walking into deals with a 15 cash on cash. I mean, it was the easiest underwriting we've ever seen. And we ran all different scenarios on how we get hurt on that, and just felt like people got to live somewhere, and people got to, and I wish it lasted longer, because all we got was basically into October, November. And then all of a sudden, and I told a few people this, my phone was blowing up off the hook from people that had never invested in multifamily, but had billions of dollars in capital in San Fran, office towers, hotel towers, institutional capital out of New York. And it kind of just made me think there might just be a little bit of a capital flow trend coming this way. And I think that's going to compress cap rates quite a bit. Now, I never, ever expected what we saw today, but we pretty much felt like it was time to get going, and that's what we did.
Yeah. Let's finish the construction part.
Yeah.
You kind of said early on that, when the first deal you ever did wasn't going well, you were on site and you picked up some paintbrushes and got a crew and you got going. And, from the outside looking in, I think a big part of your quote unquote secret sauce is how quickly you can get this done and at the cost. So to the extent you'll share, what separates you on the construction side, then call it your competitive set? What are you doing differently than most people can achieve?
Yeah, I've had the same subcontractor since our very first deal. Literally, and the guy keeps having a new brother every time I talk to him, but it's literally, his name's Rojo. He was painting our cabinets and spraying our bathtubs, with the resurfacing in the first deal. And this was at the time that I'd fired 3 GCs and we were heading into the summer, and I just didn't know what I was going to do. And I grabbed him and said, "Hey, can you do floors?" Because that was the one thing I couldn't figure out. I couldn't find anybody for doing these floors we were doing. He said, "Oh yeah, no problem. I can do it." And the next day he shows up. He's like, "There's my 2 brothers, Jesus and Rojo," and they do the floors and literally save my ass, do it for cheaper than I was getting it done. And all they wanted was, I want to be paid every week in cash, and let's go. And so that was like the first time that they stepped up. We became, we developed a great relationship, and I just kind of kept using him to expand our different resources and product, and teach us, the best ways to do different things within kind of that industry. So from there, we were able to kind of bring our own teams in, teach them that. We knew what everything cost. We knew where he sourced all the materials from. And we were able to start kind of building up mass purchasing power, put it all in a warehouse, and start storing and kind of developing our own system for that. And kind of develop these rehab kits to drop off into units. And then the labor source, is obviously the big delta, but with our labor, we pretty much figured out they all are coming here from various cities, various countries. They're here on a visa or whatever it may be, and they're here to work. They want to work for 9 months and they want to go back home, and they're going to take the money with them for a little bit. And so we were able to say, okay, you're going to be in Jacksonville for 9 months. You're going to finish all the exteriors. You're going to finish all the amenities. You're going to blow out these apartments fast as you can. You're going to make a bunch of money in 9 months, and you're going to go back, and then you're going to come back in 2 or 3, and you're going to be ready to go in Charlotte.
Yep.
And it's just like this very consistent supply. It will also work product for them, and a very consistent paycheck. And one of the things we figured out early on was these subcontractors and laborers are so used to getting jerked around when it comes to payday.
Yep.
We took the complete opposite approach. Stuff, if maybe something was, broken, or maybe manager, it was their fault, whatever. We're going to pay you what you're going to pay you. Now, we need you to come back and fix it, and we need you to come back and do the next product, but I'm not going to withhold pay, and I'm not going to start trying to beat you up, or I'm not going to fire off the job. Like, it was a respectful relationship instead of, what tends to be more of like a pushing around relationship. So we developed these relationships and have built out, 300, 400, 500 people on the labor kind of construction team. And then we got our own GC license and had to get, more serious about it. But so we have construction managers, we've got superintendents, we've got people who are on site all day that manage exterior projects, people on site that manage only interiors. And we've tried to bring kind of the same way we do management, is just more of an institutional feel to execution and reporting on a very kind of broken process for renovations.
So when you think about labor in today's market, and everybody's like, nobody's working, maybe this is, it's not a political statement, but I'm sure you're an advocate for, as I am, is like, we need to let people come across the borders and work.
Yep.
What are you experiencing right now? And both like actual what's happening on the ground versus if you were president for a day, like what do we need to do as a country?
Yeah. Yeah. Ooh. Yeah, I won't go down the political spectrum. I mean, I think we royally screwed up our immigration and our rhetoric around what needs to happen to get hardworking, smart, good people in this country.
Yeah.
Whether it be labor type people or whether it be, extremely intelligent people here on a working visa. We've seen some horror stories around people, being deported back or, their work visa not being renewed. And these are smart people who have a lot to offer America. And I'm blown away that, my parents are, my grandparents all came from Mexico.
Yeah.
Everyone you talk to that's had some success in their life, it all seems like it came from some level of immigration. So I think we got to fix it. And I think we got to fix it very quickly.
And what are you, but today on the ground, are you experiencing labor challenges? Is that your competitive advantage right now that you kind of have this team?
we definitely are. I'd say it's less on the construction side. It's on the construction side. I think are doing better than most, but we're certainly not immune. It's also very much on the maintenance side. I mean, that's a tough role to fill right now. Especially, I'd say anything in that $15, $25 an hour, any sort of labor force is extremely challenging right now. Once you get above that and kind of get into the more executive or senior kind of white collar jobs, seems like there's still a good available talent if you have a good culture.
Yeah. When those like $15 to $25 an hour employees that maybe you had pre-COVID, like, do you have any insight as to where they went? Did they take like a higher job? Did they move? Like, nobody can give a clear answer as where are these people right now?
I know. I think we're underestimating the gig economy a little bit. I think, whether it be Uber driver, favor driver, I think a lot of people have gotten creative with just what it means to work these days.
Yeah.
I think also you had a lot of investment speculation going on. I know a lot of people that would bet paychecks on crypto and, they were following all types of Reddit threads. And, for a lot of these people, if you're getting government stimulus and you're getting, child tax credits and you're getting, your crypto boom and you're getting, you can work your Uber and favor job and you can run a YouTube channel.
Yeah.
You're probably doing okay.
Yeah.
And so I think that's kind of the missing link, but I don't know what really solves it. I think, but I think the supply chain and all that is just become a disaster for most. And on our end, it's weird. It's a blessing and a curse. It sucks for execution, but it's amazing for what it's done for supply. It's totally brought it to its knees relative to what the demand is for those apartments and single family.
So what's your directive right now when you are buying? That's probably one of the benefits of owning 38,000 units is you can buy in bulk. You probably had a warehouse full going into COVID. Do you buy per project and you just have your lists, and so you're just filling the warehouse up anytime you can, or how do you think about it? Is it project specific?
Yeah, it is. There was a moment in time where we could not get paint from Sherwin-Williams. We had to go to all types of paint suppliers and buy up whatever we could find essentially in the summer of last year. It's gotten a little better. I'd say the purchasing power helps. We're hopefully at least one of the first calls from some of our suppliers. But it was a disaster, and appliances were no better. We were moving people in with, old appliances and giving them rent credits and, doing all types of stuff to try to ease the burden. But, it was nothing short of a total disaster last year, and it still really is. But on the flip side of that, like you mentioned, it's been an amazing boon for existing assets.
Yeah.
We absorbed 40,000 units in DFW and we only built 23. And this year we're maybe going to get 30 if there's not more delays. And I think we're probably going to absorb close to the same, maybe 32, 35. We're 97.5% occupied in most of our Sunbelt markets.
Yeah.
It's the highest we've ever been. And we cannot get supply. And the supply that is coming online is usually, kind of outskirts of town, not really where people want to live. And, it is creating kind of this weird dynamic of just, I hate to say perfect storm, but at least it starts to make sense of why the rent increases are happening.
Yep.
And so you can make sense of it.
Okay. When I think of DFW, 30,000, 40,000 units coming on board, or maybe it's 23,000, but we absorb 40. are a lot of the tenants that occupy the buildings that you're buying, call it Class B, are you worried about the new Class A stuff? Like, are they actually upgrading to this new? Are rents now that close that they would do that? Or
so they were. There was a weird moment in time during kind of coming out of COVID where workforce housing, let's say into 2020, workforce housing was up 2 or 3% in rents.
Okay,
and we saw most of the urban infill stuff that maybe was 3 or 4 years old or coming online was signing rents 12% below where they were a year ago. And so you had this kind of weird increase in workforce housing, and you had a pretty massive decrease on the new stuff.
Yeah.
And so that spread narrowed, for us about $150-$200, and all of a sudden cap rates became very agnostic to product type. Historically, it's probably 100-150 bips between A to C and somewhere in between, and everything was kind of a 4 cap. And so we started buying up a lot of kind of new stuff, cash flow, yield, urban infill type product that we thought, we're buying it at a 10%, 15% rent discount. And so just to get back to even, 20%, you're going to need 20% growth. And if it goes from there, great. So we started buying all that up, and I'd say that lasted 6 to 8 months. And now that spread's kind of back to a healthy, $500 or so.
Okay. Fair enough. All right. You have 3 parts of your company. We've pretty much talked about construction, some management. When you own the asset, what do you want your asset managers focused on specifically, maybe during the early days where there's a ton of activity versus now we're into year 3 and we've kind of stabilized? What matters to you when you're talking to your asset managers?
Yeah, I mean, our asset managers have a lot of authority on the business plan execution. And I think that's important because I think a lot of them truly feel like they are the owner of that asset. I don't question their decisions. I question if the performance isn't there, but day-to-day decisions, I'm not going to override them. We've kind of built out a training program that lets these people be the owner of that asset. And, from a day-to-day perspective, they're managing kind of a construction manager who's on their team, a director of operations on their team, and an analyst who's kind of helping support. And so on their team, they'll be managing, on the ground, kind of mostly construction in the first 12 months, okay. I'd say is the big focus. They're obviously managing the rent roll. They have meritocracy to make decisions, and their bonuses are all tied to NOI. So they can either hit 100% and then it goes all the way to 200% as kind of this huge threshold for participation. They also all have direct ownership either through investment opportunities or ownership in our employee affiliate pool. So I built this kind of culture around the asset manager really being the person that makes stuff happen. And, so year 1, it's all construction and operations. Year 2, it's all stabilization and start to focus on return of capital. Yeah. And so it's really a time for looking back over year 1, what worked, what didn't, where are we at in budget and where are we kind of over and under. And then from there, really, how do we get from, that point to a capital execution, and whether that might be refinance and return of equity or an exit. And that's really kind of up to them to present both cases. Yeah. And then basically they put a memo together and advise us one way or the other, sit down and discuss it. And if goal is to refi, it's keep on pressing on. And it's probably because we're seeing great growth and we figured out, the plumbing's good and we have great expense management and all these things. Or it's, hey, we feel like we had a great pop. Here's what we're seeing in the market for exits and cap rates. And if we stabilize GPR and loss lease here, we could have this thing ready to go in 22 months and sell it at a compressed cap. And so that might be the recommendation. And so then, that's what we do. And we question things and we have an IC and we do all that. But generally I want them fully executing that business plan within year 2. And then they get a transaction bonus. So they're very incentivized to move quickly, hit NOI targets, and get us to an event for capital return, whether it's sale or refi. And then after that, it's pretty easy. It's if we've done our job and all the capital has been returned from the equity, years 3, 4, 5 is just manage yield and cash flow. Yep. Then it's just stay full, keep rents with market, turn as needed, make sure we don't accrue any deferred. But the hot and heavy is the 2-year cycle.
Yep. And when you're refinancing, it's usually going to be with a Fanny Freddy, some type of government backed loan.
Yeah, we do a lot of kind of CLO product going in. Bridge financing, kind of 3-1-1 or a 5-year term, full IO, usually about 70-75% of cost. So we'll go in, do that, and then on a takeout, we'll tend to do like a 7 or 10-year floating rate loan with Freddie or Fannie. Usually Freddie's better on their floating product, so we go Freddie, but usually that returns somewhere between 50 to 100+% of capital.
I don't mean to ask the dumb question. What is the difference between Fannie and Freddie? Like, is there a big difference?
There's not really a huge difference. They have different metrics on how they have different lending limits a little bit. Some of them have different affordability kind of internally, but a lot of them just really have different metrics they use to size various loan products. And so, some days Fannie's better than the other, and some days Freddie's better than the other. Traditionally, I think Fannie's better on fixed and Freddie's better on floater. But all they're doing is literally lending. They're managing their lending cap.
Yeah.
So if their production through the quarter is over kind of through year, they think they're going to be over on lending, they start to pull back and push spreads. And then as lending dries up, they start to get more aggressive. And then maybe the other one starts to kind of do it. I mean, it's kind of a silly back and forth. They should just merge the two if they could. But yeah.
Okay. Last kind of question on execution. You buy a deal, you have bridge loan, which gives you money to do the construction, money to kind of operate. You kind of have a race to the clock to get to that 2-year window. Like, and maybe it's the same in everything. In industrial, it's like once we get to that NOI number, that's when we start the conversation with banks. Multifamily with so many units, it seems like it's just a little more fluid. But is it as simple as like, hey, we are trending to this NOI number? We know it's going to take us 60 to 90 days to get the loan closed, like kick the process off. Is there something that,
I think that's what makes you a good investor, is having that ability to kind of say, I feel the value that's been created and I can see the trajectory, so that, let's start the process. And I mean, that can be the difference between, a gross 20 or a gross 15, is just being to the process, 6 months earlier than the other operator. And so we're constantly evaluating that really on a month to month. We have kind of our own internal process for basically stabilizing GPR, current GPR, what last 30 rents are, push that, and then kind of spit out a bunch of different NOI scenarios. And then you kind of look at it and say, well, what's that one doing and why? And then you start to kind of deep dive and say, okay, that's the one to do. But yeah, we're very much, it's like I said, it's not rocket science. If you're signing renovated lease at $1,600 and you're doing 20 a month, you pretty much can figure out, okay, 3 more months, I'll have X amount of NOI, and I just got to fill it up and we'll be good.
Is there anything from a CapEx standpoint when I know a lot of guys that are getting into the industry probably call you, like, where do most people in today's market just totally miss the boat?
I'm always blown away at how much people spend on their CapEx. We've done a couple projects like helping people out, and we'll do stuff for, literally half of what their budget was or what they're used to seeing. We've got equity partners that, require us to do stuff maybe at 20 a door, and we get it done for 12 a door for the full rehab. So I think there's a lot of just kind of excess in the construction market. I think a lot of people miss the boat on ability to really drive rents while maintaining occupancy. A lot of people, it really is a very delicate balance to maintain yield, to not build basis because you're cash flow negative, and to be able to also drive massive in-place rent growth is a challenging thing to do. And a lot of times people get behind the 8 ball so that their growth isn't slow because they're scared of occupancy. And I think that's where people mess up the most, is they have this fear of being 87% occupied or 88. It seems like to them they're failing, their NOI sucks, it's not a great deal. But if the investor will let us, usually if we have control, we're going to 82, 85 as fast as we can.
Okay.
And all I want to do is just go down fast, up fast. The worst thing I think people can do is a slow burn of slow growth. And, you're stuck in no man's land because you haven't generated enough NOI value to actually do a capital event. So now your investors are upset, and you also, so now you feel like you have to do it, but now your IRR's crushed. So then you start building basis later in the game, and it's just a bad plan.
Okay. All right, I want to spend the last kind of segment on kind of what's going on today. Let's just talk about your portfolio. Are you still going after the exact same stuff that you always were? I've noticed, and maybe we can talk a little bit, that first project you did 9 or 10 years ago, that's probably up for a value add again.
Yeah, it still has the same damn colors. I saw it just sold. I'm like, someone needs to paint that thing. It's ugly.
How are you refreshing your portfolio? Like, what matters to you based on what you know in the market today?
Yeah, I mean, you know, what's crazy is what a 2012 product looks like compared to 2022. And so I think we've updated what our term, what value add means. You know, we bought a 2014 deal in Charlotte in kind of what would be considered the North Park Mall area of Charlotte. And we're going to do a full gut rehab of the interiors. And it was built great for the time, but it's all browns and kind of, you know, dated. And we're getting great rent pops out there. And what I've figured out quickly is from a scalability and resource perspective, it's incredibly challenging to scale a super heavy distressed value add platform.
Yeah.
You know, what we used to buy just by default because no one would pay attention to us was, you know, 60s, 70s stuff in rough areas. And, you know, we were really good at that. We were good at figuring out how to add value. We were good at fixing stuff for cheap and moving the meter. But when you start buying deals like that in Jacksonville and then Charlotte and then Florida and up and down the I-4 corridor in Florida, and then you've got some stuff in Dallas that's hairy, and then, you know, Houston that's hairy, your team and your resources become extremely stretched, and it's very stressful, and you're not usually in a very good cash flow position for 24 months. Like I said, you've got to tank occupancy. You got to get comfortable that you're going to bleed some cash and it's going to be a little painful for a while, and you got to have confidence that you'll come out of it. And so what I quickly figured out was, you know, if we want to be 50, 100,000 units in, you know, call it 10 years from now, we've got to kind of figure out what's truly scalable institutionally into 15, 20 markets. And it's really getting, you know, more into that kind of 90s, 2000s product type. I kind of started studying the top 10 owners of, you know, who's built the best platforms. They weren't buying the stuff we were buying. You know, you look at the Forbes 500, you don't find a lot of 60s real estate syndicator deals on there. You know, it's all very...
You could have been the first.
Yeah, I know, I was trying. And so it's like, you just kind of look at it and say, okay, these guys and girls are all figuring out how to do it on a very institutionally scalable scale. And so that was what we focused on, was moving that product type. And it you know, you have a lot less CapEx needs, you have a lot less deferred, you can find good employees and your tenant base is just a lot less rough on the asset.
So like on that deal in Charlotte, you're taking, you know, the 2014 product, you're modernizing it to today. Is it the same people that's still leasing it, or are you attracting like a new tenant that would have never been there before on a project like that?
Yeah, I mean, I think what you're doing is creating the value for. So in that deal specifically, you know, let's call it in place rents of $1,500. We're moving them to $1,800, and new supply is delivering at $2,100.
Okay,
so that's what we want to be. We don't need to necessarily compete with new supply. We just want to be the well-located value play.
Yep.
And so I don't think, you know, I think probably 30-40% of those tenants stay there. They take the upgrades, and then the rest is you're finding a new tenant that's looking for the value play.
Yep.
And I would say you walk into our units on something like that, and you wouldn't know the difference of whether it was new built or not. I mean, it's got all the, you know, smart apartment technology packages. It's got the wine locker. It's got the stand-up showers. It's got the kind of kitschy, you know, closets and all that stuff. So, you know, I think that strategy works well.
Yeah. We've talked a lot about CapEx, but we live in 2022. Is there any tech that like has kind of, you're actually like, this is pretty badass? There's been a lot of stuff that comes out that doesn't seem like it's going to work, besides paying rent online and all that stuff. I don't count that. But is there anything that's come out that you're like, this is pretty awesome?
Yeah, we've had a tough time with it. I mean, you know, back to Adam, you know, he and I started a smart apartment technology company, you know, 5-6 years ago, and sold it to Vista Equity Group.
Zego.
Probably 3 years ago. And then Zego just sold it again. Yeah, exactly. And, you know, that was at the time where, you know, you weren't seeing as much of it, and it quickly became, I'd say by 2018, extremely crowded. And to this date, I honestly have not seen anything that I think is like super mind-blowingly cool. Fetch is pretty cool from like a delivery, a package service. I think that's an interesting concept, and I think that's probably one of the biggest challenges we've had.
Yes, go on that for a second.
Yeah,
like your delivery rooms must look like.
Well, I mean, we have some 800 unit properties that I'd need some industrial space from you to manage it. It's like it is insane, and so it's genius on the Fetch part is like, okay, we're going to basically become a centralized storage system for in-house delivery, and so all your packages come here, and then we hand deliver them, to these complexes for a small fee. And the tenants love it. And so that's kind of blown up, and they have an interesting tenant technology app that they use. I think rent and all that kind of stuff is basically just going to go to the cheapest execution. I don't think there's anything like mind-blowingly cool there.
Yeah.
The smart apartment technology packages, we get good rent. I mean, so it costs us $12 or 15. It costs us usually about $12 a month to operate kind of the cell service and stuff that goes along with it. And it's usually about $1,000 to install it, but we get a good pop on it. It's usually $35 to $40 from the tenant.
Yeah.
So they like it. I mean, it's what you'd expect. You can control it from your phone, unlock your apartment if someone's there to see you and you're not home yet, or control your AC and thermostat. But I'd say a lot of stuff is big on promises, poorly delivered.
Yeah.
And that's still kind of just what we're working through. So we've hit the brakes.
But are they all like, if I go to rent at one of your spots, do I need to download like a Fetch app, a light turn on app? Do I have all these different apps, or is it now being aggregated into one kind of box?
One system?
Yeah.
Some people are trying. It's, that's kind of what like Resman and RealPage are all basically buying up these companies, is to say like, we're the one-stop shop.
Yeah.
The problem is it never works out that way.
Yeah.
I think we're tired of being the guinea pig.
Yeah.
And so we've kind of just said, let's focus on what's important to the tenant, and it's not having the latest and greatest AI package and technology. I mean, a lot of what's important to these people is a good, clean, safe home.
Yep.
That's affordable for them. So we almost have to shave it down a little bit.
All right. There's a few more. This one you're not leaving. This was like the big one. You have raised deal by deal forever.
Mm-hmm.
You've bought over $6 billion, so you've probably raised over $1.5 billion of equity at this point. Deal by deal.
Yeah, freaking grind.
And then the alarms start ringing that Scott is raising a fund. Why are you raising a fund?
Yeah, that's a great question. I ask myself that every day, but I guess I'm just a total glutton for punishment. But it's the reality is we look over our company and say we have control and vertical integration of everything that touches the apartment complex that we operate in, except for the most important aspect, which is our capital.
Yeah.
And it becomes apparent when it's not available how imperative it is to have. And so, it just kind of hit me, 5 years ago I said, well, maybe we should do it. It would be nice to have. And I'd say fast forward to today, and it's gotta have, if we want to grow the way we want to grow. I mean, I raised $700 million of equity last year.
Yeah.
And, it's a freaking beating to do that over 27 deals that we bought last year.
Okay, but you're like, hey, Sanjay, hey, Pennybacker, got another deal. I'm done.
Yeah. Okay. Until I won't say the name. A Canadian life insurance company is 2 weeks from closing on a deal that I have $3 million hard earnest money on, and they call me and say, actually, we aren't going to do this deal, but we will do a super pref structure. You can put in 15% of the equity. You'll be subordinated to our equity and also subordinated to the loan. We get a minimum 15 return, and then you get all the upside. What a great deal. Well, that's great, but no, screw yourself.
Yeah.
And we've had that happen a few times.
Okay.
And, it's like they knew they had my balls in a vice. They knew they had me against the wall. They knew closing was coming up in a week or two. We had a lot of earnest money out. Then it's less important about the money. It's our reputation.
Right.
We win deals, and we get deals awarded to us because we never retrade. We always close. We close on time, and we just get stuff done. And so for them to try to pull that, it's just one of those things. And it happened a couple times, and it's just, what it makes you realize is great partners are so hard to find, and when you have them, you treasure them. But when that happens and you've got 9 other deals going and other stuff starts happening and lenders are having issues, you just kind of realize, like, I know it's a beating to have fun, and I probably don't make as much money on a deal-by-deal basis, but it's a smaller slice of a bigger pie, and it gets us to where we want to be, which is not just, buying $40, $50 million deals at a time, but we really want to become a massive capital allocator in multiple markets and be able to institutionally build up an investment team. And you need those fund management fees and all the stuff that it generates to kind of help do that, because it's expensive.
To speak to in a specific, or you can say pound sand, I'm not telling you, but do you think about the fund as, I'm going to try and achieve similar to like syndication economics at a fund structure? Like, are you still able to get all the goodies that you like?
No, I mean,
are there give and takes?
So the other, and I'll also speak to this, fund equity and fund, management really creates enterprise value that you don't have doing deal by deal or some sort of syndication shop. No one cares about your AC fee. No one cares about your construction fees. No one cares about your management or asset management. But as soon as you put equity management on there, it becomes the most sticky institutional attraction. I mean, you see it in TPG going public. You see it in Bridge Investment Group going public. These things trade at 23 times earnings on EBITDA. And it all gets wrapped up into one, but it doesn't matter at all until they have the equity management fee, because it's paid before the damn loan service sometimes.
Right.
And so they know that's sticky cash flow. And it's also something that's sticky enough to build a massive operation around and to continue to scale. But back to the syndication question on just, how you structure those deals. When we raised money, it was a 10 per 50-50.
Yep.
Oh, that's fantastic.
Yeah.
And it's never going to happen in an institutional world. So now we're an 80-20 over 9 with some catch up in the 9. So we're basically, 1.5 equity management fee, which is pretty standard, and then 20 points of the profit. That was hard to swallow at first. I think fortunately for us, I'm in a position where I'm less concerned about making a bunch of money on one deal, and I'm trying to figure out, how do I build true company enterprise value over a 10, 20, 30-year period and build something that can rival, Starwood, which would be, I know people always, who are you looking up to? Blackstone's cool and all. They do a bazillion things. I think Barry Sternlicht and what Starwood's built is just, if you could just replicate that, I think he has done a phenomenal job of becoming a true institutional real estate private equity leader across many, many different forms of real estate, and aggregating up to, I think 110 billion of AUM these days.
Barry, if you're listening to this,
Barry,
and I know you are, call Scott.
Fan of the fort. That's right.
So it's fair to say you're just you're leveling up the company, and how you raise your capital and your capital stack is what I'm seeing is, one, you can buy what you need to buy, move quick when you want to move, but you're building a new type of value for your company that didn't exist before. And maybe the trade-off in promote.
Yeah.
Yes.
And it's a new offering and opportunity for our employees. And, nothing gets people more excited and motivated than new forms of growth. Whether we're hiring out senior fund accountants, we're hiring treasury management, we're hiring, new investment teams. We want to be in different regions within the investments. Hopefully we can start to talk about open-ended core plus vehicles. We can look at, pref equity, bridge debt for multifamily. These are all long-term kind of thought processes, but you don't really get there by saying, hey, I'm going to give you money and then I'm going to go figure out how to raise it 200 grand at a time.
Yeah.
You have to be able to call, I'll never forget, but one of our partners in DC who's been doing this 12 years now as a fund manager, the guy started a company 10 years before that and then started this company as a private equity fund manager. And they're about the same size as us. They're 20,000+ units or so, but they had a portfolio that needed about $450 million of equity, and in 9 days put $300 million from the fund, and within 9 days got $50 million from 3 more investors for $150 million from Neister's pension, Cal, whatever, and Texas teachers. And all it took was a investment memo and a phone call. And, that is
Yeah.
That is pretty powerful when you're trying to build a company and find good deals.
Is there something, if you're going after $1 billion deal, and I'm pretty much asking a question I think I know the answer to, but when you're going after a $60 million deal or 100, that's a big number for a lot of people. Is there, I've never gone after $1 billion deal. I think you have. What do you get asked at the $1 billion table that you don't get asked at the 50 or 100 million? Or is it just like, do you really have the money?
Yeah. You know, we closed a 9-pack last year that was right at 950 million. So, you know, it was one equity group and they basically put their entire fund on it. It was, you know, 280 million or so of equity. I'd say that honestly, you know, it was a lot of earnest money. It was a little painful on that end. And I'd say that what was amazing was what felt like the biggest transaction of my life. Blackstone was our lender. I mean, they closed it like 30 days as if it was just like falling out of bed. I mean, they weren't even excited about it. I was like, can we get a closing dinner on the books? Is somebody going to answer my email? I mean, it was insane. But what it taught me was, you know, no matter how big of a fish you might be in your little pond, it just gets bigger and bigger and bigger.
Yeah.
And the more that you can challenge yourself to just think bigger and not be afraid and just go for it, you find that, man, there's ways to make this happen. And, you know, it was a huge transaction and it was like, done, move on. And, you know, now we're off to the next challenge.
So when I hear and, you know, again, I think you're raising what, $200 million fund right now?
300,
fund one?
300.
300. Okay. But that deal you just did, you raised 280.
Yeah.
Would you just dedicate a whole fund to one deal, or are you going to?
Well, it was a 9-property portfolio. So our fund has restrictions around, you know, no more than 20% allocation in one asset.
Okay.
So that means $60 million check, obviously. You know, none of these deals that we're right now negotiating a 9-property portfolio. Again, I guess number 9.
Yeah.
You know, it'd take up about $240 million or so of our fund. I would probably raise co-invest of about 100 of that, so I don't blow my first fund right out of the water.
Right.
But that's kind of what you. So there's interesting what happens as you step into this kind of institutional game is now Goldman says, hey, did you know about our little bucket of V capital over here?
Yeah.
You know, we need co-invest opportunities. We can't actually, because of their tax structure with the capital, we can't be more than 49% of the LP. Well, that doesn't really work when I'm just trying to like quickly raise money or bring in a institutional fund manager on a one-off. But when I need a co-investor for my fund and they don't need control provisions and they can be less than 50% of the capital, well, now it's all of a sudden a great married relationship and they've got billions of dollars.
Yep.
And so, you know, a little $50 million check is like a starter pack.
Yeah.
And so it just teaches you to think bigger and level up. And you know, that one deal, it would have been great. I would have, you know, I'd buy that same deal today with our current fund, even though, you know, it was done the last time. So
does it matter to you in raising that 300 that you get some big institutional names within that stack? Like you wouldn't want it from 2,000 individuals, or would you care?
You know, we certainly don't want 2,000 people. We are targeting a lot of our family office and endowments. The pensions, you get into a whole nother level of diligence. I mean, I'm filling out 75-page questionnaires, and it's questions you've never actually thought of for your own company. And what you've learned is that, no one wants a first-time fund. So we have a 10-year track record. We've sold 20,000 units, $2.5 billion or so of value, 50 gross IRR over 10 years.
Doesn't mean anything.
Doesn't mean shit.
It's no shit.
They say that's great. Have you seen the new cap rates these days? Probably can't do that again, can you? Yeah. And it's like, so what makes you special? Why should I give you money instead of the guys that I've been, investing 150 million with? Why don't I just give them 200 million instead of you 50?
Interesting.
So they literally, when I tell you they don't care, they do not care.
Well, okay. So what do you tell them back?
Well, you got to craft a full narrative. You got to deep dive. What makes you special? And so, what they care about is, it's great you're raising a fund. It's great you have a 10-year track record and you have a great reputation and whatnot. Come back to me when you're real. And what to them means you're no longer what they call an emerging manager. And that means you need to be over $1 billion of equity raised to even start the conversation is no longer emerging. Or you need to be into fund 4. And so then they can see a track record of how your funds perform, because it's a very different animal. But what it's taught me is that you're never big. Don't if you start thinking you're too big for your britches, just settle down, because it blew my mind. You need $1 billion of equity raised to even have a conversation as not someone who's basically a startup.
Well, now, and with BREIT raising $2 to $3 billion a month, like even being $1 billion fund now is like, what value are you really bringing?
Well, what's crazy is I talked to my fund managers who, are at $1 billion or $1.2 billion, and all they're freaking out about is how much money is just being gobbled up by Blackstone and Starwood and Brookfield and those types of groups. And I mean, these people have $1 billion equity funds. So I mean, they're buying $3-4 billion with leverage. And they basically believe that if you're not into the $2 to $5 billion equity fund range within the next 3 to 5 years, you're probably going to go out of business, because the consultants and the pension and the endowments, they no longer want to mess around with dabbling in a bunch of different strategies with operators. They pick their one group. You make them $500 million on their $500 million check. They want to give you $1 billion. And they've got so much overhead and issues with their, the pension system is so screwed up that their pain points are not about, they don't want a 50 IRR. I think they'd probably be fired for not producing it the rest of their lives if it happened. What they want is someone who can very consistently deploy their capital and beat their overhead and beat their, unfunded liabilities. That's all they care about.
Well, you might have just answered the question. If I ask what your 5-year goal is, it's probably to be at your $2 or $5 billion.
Yeah, I think, so we've got $300 million in this fund.
You'll deploy that quick.
Yeah, I think it's going to be gone by July or August. So we'll start in the summer, kind of fund 2. We're going to go for at least 5, maybe 6. Hopefully that's when we start to have some institutional money come in. Right now it's a lot of family office and some endowment kind of stuff. And then from there, we've got to get to $1 billion. Because $1 billion, it's historically a fund, it takes a lot of travel and effort and Zoom calls to raise that money. The consultants want to sit with you 10 times before they commit, and there's 50 of them. But then once the money starts and they've checked the box, it's a 5-person investment team managing, $100 billion.
Yeah.
So once you're done, you're done. The money starts to flow if you do your job. But getting there is a pain. So we want to get there. I'd say third fund needs to be at $1 billion, and then we can stop fundraising every, 9 to 12 months. And that gives us, usually you have about a 2 to 3 year deployment window. So if we're putting out $350-400 million of equity or so, and you bring in some co-invest, we're happy there.
All right. Man, you've gone the distance with me, but I got a couple more. I'm not going to.
No problem.
This is a
I
big
made it all the way out here.
It's amazing.
Keep it rolling.
No, dude, it's just unbelievable. I said at the beginning, you make me think bigger, and I already feel like I've learned something new today. That was one of the best answers to why to raise a fund I've ever heard.
Well,
from someone that's raised over $2 billion, almost $2 billion, doing it deal by deal. It makes a lot of sense.
Yeah. I mean, it's one of those things that once I really sat down and mapped it out, I said, I mean, maybe I should have done it sooner, but and I love, I think Elon said this: take your 10-year plan and try to do it in 6 months.
Yeah.
And you're gonna fail, but you'll probably be a lot further than if you'd said, let's make it a 10-year plan. And so
I give Johnny the finger because at the beginning of every episode, there's like a quote that we start with. That's the quote.
That's the finger quote.
All right. The pensions are, the fund guys ask you, I know you did 10 years and you have a gross 51 IRR track record and blah, 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 but why now? Sunbelt's hot. Money's cheap. You can't build housing quick enough to keep up with demand. The markets that you're in, everybody's moving to. Like you said, the perfect storm. Like, is there anything out there besides rising interest rates that scare you?
I'm less actually fearful of rising interest rates and more fearful of what the Fed's going to do.
Yeah.
And I don't necessarily mean that means anything about raising rates. 20% of every dollar in circulation was created in the last 2 years.
Yeah.
They've $9 trillion sitting on their balance sheet. We have a 10-year that really can't go any lower. We have LIBOR that can't go any lower. We have inflation picking up. I mean, I can make the pitch all day for why I think multi in the Sun Belt's a best investment you're going to find. That doesn't mean that I think anything's bulletproof right now. I mean, I'm slightly terrified of what this looks like over the next 5 to 10 years. And so I'd argue that, the whisper of quantitative tightening dropping the NASDAQ 20%, nothing's actually happened. And, crypto's down 50 and NASDAQ's down 20. What happens when we actually start running through this? And, I'm less concerned about interest rates, and I'm more concerned about what happens to that investment demand. What is lurking out there, like synthetic CDOs, that took down the '08 crisis. That's all stuff that no one actually knows about until it's too late.
Yeah.
And we've had a long bull market and a lot of money made and a lot of people who are speculating, why is Bill Huang worth $10 billion? Why is he doing what he was doing? And how many more are out there like that? Because they kind of operate in a shadow market. And that's the stuff that I just think, at some point, it's got to kind of slow down a little bit.
Well, then you got like Evergrande over in China. It's like a $500 billion fund, just goes tits up. And
yeah.
The world. I said this on another, and you bring this up, it makes me think about it, is I think like in '08 and '09, we didn't have social media. Like, I don't think COVID could have happened pre-social media.
Right. 100%.
COVID exists because we hear about it 100 times a day. Now, I'm not dismissing that it's
right. It's
science.
It's there, but I feel like the just constant communication and ability of information has really just taken it to like what it is today.
So it's like, what is bad news anymore? Like, what is the thing that people are like, shit, we're finally scared?
I think, we've had just such a, there's so many great books around the Federal Reserve and what they've done and what they're willing to do. And I keep trying to say, like, I learned through COVID, don't fight the Fed. But at some point, you just can't buy up 10% of the, 20% of the financial instruments and assets in America and maintain kind of what we've got going. And so I think that's what's caused crypto to become so, everyone's such a nut about it, is people are concerned about the dollar. They're concerned about currency. They're concerned about inflation. And, it's something that's just totally unprecedented.
Yeah. All right. Two more, then we'll bring it home. You can answer this or you don't have to. And if you don't want to, you don't have to. What I think's really cool about your business is you do it with your brothers.
Yeah.
That's a really delicate subject. That can go really right. That can go really wrong. What's your words of wisdom for how to build a solid family business?
I think it's setting expectations clearly up front.
Yep.
I think it's also understanding what those responsibilities will look like. My brothers, I did not purposefully hire them. The first one I did, Mark, was really my first employee, and he got a nice offer from a consulting company when he got out of tech with a finance major. And his in-laws basically did tell him, don't take that job with your brother. He's running like a Ponzi scheme or something. So, like, literally, don't do it. Like, you're with our daughter. You need to go get a nice little consulting job. So he took it with me, and he's been such a key component of just everything we've built. He's our managing director of asset management construction, and so everything that happens after closing or through closing even falls on his plate. And so he has built out an amazing platform. And what I realized all about my brothers especially was a lot of their strengths were a lot of my weaknesses.
Yep.
Mark brings a lot of organization skills and execution that, my big ideas and just kind of running around like a crazy person, they don't really translate to real life sometimes. So he's done a great job of that. And then, it's like one of them, I know he's extremely financial and analytical, and I knew he'd be great in this role. And so you put him there. And then I knew the other one was, had a different set of skill set. And so I think if I tried to force them into the wrong roles, it could have imploded.
Yep.
What we figured out was put people where they're successful, and you don't get any sort of special, and basically what I told them straight up was, they know this, but if I ever heard, I'm his brother, or I'm a family member, you'd be fired immediately, and there's not going to be hard feelings about it. And if you want to cry about it, then go cry about it. But we got a business to run. Yep. And what's great is that all of them recognize that.
Yeah.
And having brothers and someone you can trust and someone you can make money with, that's something that I think a lot of people don't have in life, is celebrating your success with people that you care about.
Yep.
It's tough to do. And sometimes it can come with a lot of jealousy and emotions with a partner. Maybe that partner doesn't pull his weight, so you're like, hurrah, hurrah, but I should be getting your piece, or you shouldn't be a part. So it comes with a lot of emotions, and having family
who I've got to watch, buy a home, renovate a home, build a home, get married, have children, start investing in things. We all came from nothing. We shared one bathroom. 4 boys as teenagers taking 45-minute showers was a disaster. And so, it's just one of those things, like, to see where it's all come to has been amazing.
I think it's one of the coolest things you have going for you.
Yeah, I love it. And we're
awesome.
We're big enough to where it is, we're not on top of each other. We each have our own kind of roles and responsibilities, but we all love the same stuff, and they would love nothing more to see me become 10 times more successful than I am, and also understand that I take a lot more risk.
Yeah,
I sign debt. I put up a lot of earnest money. So it's never been a sense of like anyone looking in the other pockets or anyone trying to get what the other had.
Yeah,
everyone's just marching to just do the best they can.
Yeah.
And I think that's,
dude, I think it's
awesome.
I've watched it. I've it's super cool. I don't have 3 brothers, but I don't know. I just think you're getting to live out something pretty special.
Yeah,
that's awesome.
Yeah, thank you.
All right, last question. The S2 Foundation. You provide. I think you do a lot of charitable work, and we don't have to go through all of it, but I think you do 5 college scholarships every year.
Yeah, we do about $20,000 a kid.
Okay, how did this all come to be? What do you do?
So we didn't do it as much right in the heart of COVID. We actually pivoted to doing small business pandemic loans, which we could go down, but was actually amazing because I gave 0% interest rate loans to different companies that needed money for liquidity, and all have paid me back totally in full through COVID. So we pivoted to that, but prior to that, we were doing basically, student would apply. They had to write a paper on a business idea. It was always geared towards kind of, entrepreneurial, lower income households. And so a lot of those kids have graduated now, and I've helped kind of connect them to different, whether it be like a capital market shop or someone in New York that we know or whoever it may be. It's been so, it's just been so special to kind of see putting those people through and seeing kind of the creativity, and a lot of them bring their parents. So I make them interview. So their kids coming, they got to answer a bunch of kind of questions. They got to fill out apps and resumes. And then the mom's coming, and the mom's making them kind of sit up straight and talk. And, it's pretty fun to watch. And so we do the $20,000. It's paid out in quarterly kind of installments for each year. And yeah, it's $100,000 a year. It's not much, but I think it's been super impactful, and selfishly, it's been a lot of fun to watch.
Yeah.
And then, we do a lot of other, I'd say, yeah, really where the philanthropy and whatever you want to call it, charitable, children have always kind of I've always felt, pulled and gravitated towards helping and assisting, the what I kind of consider defenseless. If you're not helping and fighting for them, no one else does. It's like there's a lot of great causes, the environment, the animals, and homeless, whatever. But a child, I'm on the board of Dallas Children's Advocacy Center and Children's Cancer Foundation. And the stories, for DCAC, we see about 8,000 kids through Dallas for child and sex abuse and physical abuse. And it is something that the more you become involved, it's horrific. But then you start to understand the work that some of these people do and what these institutions provide to their families to get them through, whether it be a court date to prosecute an uncle or whatever it may be. You just start to feel really compelled to give more, do more, and help these poor kids and families. And so that's where, kind of the kid and the scholarship thing, DCAC and CCF is just, it's really pulled at my heartstrings.
I love it, man. All right. You're a giant. We're going to do this in 10 more years.
Let's do it. Hold me to it,
man. It really is just awesome. So thanks for sharing the mic with me today.
Well, thanks for having me.
This was great.
It's been a great time. Let's do it soon.
Yeah, we'll do it.